Have you ever wondered why bubbles always seem obvious, but only after they burst? When you're inside one, it feels like the rules have changed. Prices climb, confidence swells, and anyone who hesitates looks foolish. But then, almost overnight, the music stops. The same people who were cheering now whisper the word crash. So what actually creates a bubble? Some say greed, others say speculation, but the truth is more subtle and far more human. Imagine you're the first person who notices a small, promising company. You read a few articles, maybe glance at the charts, and think, this might be worth something. You buy a few shares. A friend sees you doing well and joins in. Then another. Soon, everyone's talking about it. Not because they all did the research, but because nobody wants to miss the ride. That's how most bubbles start. Not with madness, but with imitation. A few rational decisions ripple into a crowd movement. Traditional economics assumes we're all rational actors, that markets reflect logic, but in reality, markets reflect emotion amplified by technology and multiplied by the millions of tiny decisions we make every day. Think about it. A century ago, buying a stock meant calling your broker and filling out a form. Today, it's a tap on your phone. Algorithms trade in microseconds, reacting to news faster than you can blink. And in between, there's you and me, scrolling headlines, following trends, feeling FOMO, trying to make sense of chaos that moves faster than thought. This is the world of complex systems, where billions of small actions create patterns no single person intended. Here's where it gets interesting. Researchers studying financial markets began applying ideas from physics, yes, physics, to understand how patterns emerge from chaos. In physics, you can drop a pebble into water and measure the ripples. You can find symmetry, scaling, and repeating forms. Financial data, it turns out, behaves in a surprisingly similar way. Every market rise and fall, from milliseconds to months, has the same shape: a rise in excitement, a sharp peak, and a rapid fall. Like the sound of applause fading in an empty hall. It doesn't matter if it's Bitcoin in 2021, tulips in 1637, or tech stocks in 1999. The curve is the same. The story is the same. The emotions are timeless, but there's more behind that curve than just price. Hidden inside every bubble are two types of data: what we do and what we think. The first comes from transactions. Every click to buy or sell, every trade executed by a human or an algorithm. The second comes from what researchers call our digital shadow, the trails we leave when we search, post, or scroll. When people start Googling how to buy gold or stock market crash, that data forms a mirror of our collective anxiety. It's as if the internet itself starts whispering our fears before we say them out loud. In one study, researchers tracked search terms like debt or financial crisis. When searches for those words spiked, markets often stumbled soon after. It's not magic, it's psychology, fear spreading through search bars before it shows up in prices. Now pause for a second and think about how wild that is. Our emotions, curiosity, fear, excitement, are measurable, quantifiable, and tradable. The same digital trails we leave when trying to understand the market become signals that move it. That's not a glitch, that's feedback, a system feeding on itself. And that feedback loop is why bubbles keep returning. Every click, every share, every Google search adds a drop of emotion into the global pool of decisions. Eventually, that pool overflows. So what can we learn from this? Let's start with humility. Most people think they can spot bubbles, but if you could, you'd never be in one. The moment you're sure something will only go up, you're already part of it. The moment you start telling others about your sure thing, you're spreading the infection. Bubbles don't happen because people are stupid. They happen because people are human, social, emotional, hopeful creatures trying to read signals from a noisy world. But this also means bubbles can teach us something deeper about ourselves. They reveal how much we crave certainty in an uncertain world. We tell ourselves stories about progress, innovation, freedom, wealth, and those stories pull us forward. Sometimes too far. The trick isn't to stop dreaming. It's to recognize when the dream has started driving the math instead of the other way around. Let's continue this journey by exploring how these patterns, the data trails, the crowd behavior, the self-reinforcing optimism, can actually be used to understand and even anticipate market shifts.
Imagine the internet as a giant mood ring. Every search, every scroll, every late night "should I sell my stocks" adds color to it. Most of the time it glows calm blue, curiosity, routine, background noise. But when panic spreads, it turns red. Before markets collapse, the internet usually trembles first. Researchers discovered that spikes in Google searches for words like debt, crisis, or subprime tend to show up before big drops in the stock market, not after, before, as if fear itself were measurable, one search at a time. This idea flipped traditional economics on its head. Economists had long believed people made rational decisions, but when search data moves markets, rationality looks more like wishful thinking. We don't buy stocks just because of earnings reports. We buy them because of what everyone else seems to be buying. We sell them because of what everyone else seems to fear. The market, in other words, is a social mirror. It reflects us, multiplies.
There's a saying in physics, the system is more than the sum of its parts. That's true for galaxies, hurricanes, and investors. Each decision is small, but together they create weather patterns of wealth and loss. On the smallest scale, milliseconds, trading bots battle for advantage. On the largest scale, decades, investors and governments chase growth. Between those extremes lies the heartbeat of the market, human behavior. What's fascinating is that no matter the scale, the pattern repeats. Rising optimism, growing volume, sudden exhaustion, sharp fall. A perfect symmetry of greed and fear. It doesn't matter if it happens in seconds or years, the rhythm is the same. It's like nature itself has a template for euphoria and regret. Now think about what this means for us on the passive path. If bubbles are part of human nature, then predicting them might not be the goal. Surviving them is, and maybe even using them to our advantage. You can't time emotion, but you can prepare for their consequences. When the crowd buys out of excitement, discipline feels boring, but boredom builds wealth. When the crowd sells out of panic, calm feels foolish, but calm builds empires. Most fortunes are made not during the boom, but in the silence after. That's when the noise fades and patience finally has room to work. Here's the irony. The same data that reveals collective fear can also reveal collective opportunity. When search trends about crash or recession explode, it usually means panic is already priced in. People are no longer acting rationally, they're reacting emotionally, and emotions move faster than reason. By the time the average person feels safe again, the market has already recovered. That's why the best investors don't just study numbers, they study behavior. They understand that behind every chart is a pulse, behind every price is a person. There's a quiet strength in doing less, in resisting the urge to refresh, predict, or control. Because the deeper truth about markets and about life is that they both run on feedback loops. The more you chase control, the less of it you have. The goal is not to outthink the system. It's to step outside of it, to build a strategy so simple it doesn't depend on predicting moods, to own things that grow with time, not with trends. That's what the passive path is about. Not trying to predict the next bubble, but making sure the next bubble doesn't decide your future. Bubbles aren't mistakes. They're reminders that progress without patience always ends the same way, that knowledge without humility breeds chaos, and that the market, for all its noise, is just another reflection of us trying to make sense of uncertainty. If you can learn to stay calm when others rush, to think long-term when others think hourly, and to find opportunity where others see fear, then you've already mastered the hardest lesson of all. The real bubble isn't in the market, it's in our emotions. And the moment you stop feeding it, you begin to build something that lasts. If there's one thing to take away from this video, it's this. The market will always swing between fear and greed, but your power lies in staying centered while the world tilts. Every decision you make today plants the seed for your future calm. If this video helped you see money, markets, or human behavior in a new light, give it a like. It helps more than you know. Subscribe to The Passive Path for more stories that make wealth make sense. And share this video with someone you care about, especially the one who checks stock prices a little too often. I wish you clarity, patience, and the courage to stay calm when the crowd panics. Feel free to explore the other videos on this channel. Each one is a step toward building the kind of freedom that lasts. Take care of yourself, and I'll see you in the next video.